Hello viewers, welcome to my channel. I'm Hasham. Now I'm going to start the problems on income from other sources. Last video I have explained you the provisions regarding the incomes which are taxable under the head income from other sources. So many videos I've explained there are 5 heads of income given by the Income Tax Act 1961. The 5 heads of income are income from salary, income from house property, profits and gains of business and profession, capital gain, and lastly income from other sources. This last 5th head is the residuary head. That means if an income does not fall in the first 4 heads, then it will be taxable under the head income from other sources. It's a residual head. So first of all, an SSC has to test whether his income falls in the first 4 categories. If it is falling in any of the first 4 categories, it is taxable under that head. Otherwise, if the income does not fit in the first 4 heads, it will be taxable under income from other sources. So we cannot give the complete list of incomes which are taxable under the head income from other sources, because any income which does not fall in the first 4 heads put to tax. But we can take some few examples. Examples of incomes are interest on securities are there. Apart from interest on security, dividend income, interest on bank deposit, and rent or hire charges from letting of plant, machinery or furniture, family pension received, commission received, examination remuneration received by the teacher, apart from salary. So many examples I have explained you in detail in the previous video. So if you have watched that introduction part, definitely you will find easier the problems. The problems are completely based on the provisions. So my suggestion, if you are genuinely interested in getting the knowledge on this income tax subject, don't skip the introduction part. Watch the introduction from beginning till end. Definitely you can enjoy learning the problems. You can easily understand the problems. So if you have not watched, I suggest you to go to the playlist of my channel, select the subject Income Tax 1 for the assessment year 2021. Select the topic income from other sources, introduction. Watch the complete video and then come to the problems. If you are new to my channel, first time if you are watching me, then I suggest you to visit the playlist of my channel. So many subjects I have uploaded. Advanced accounting, financial accounting, cost accounting, corporate accounting, managerial accounting, financial management, investment management, business statistics. So many topics I have uploaded. Select your subject, select the topic, watch the video and increase your knowledge, get the confidence on your subjects. Now I am going to start the problems on income from other sources. So before starting the problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. So take a hard copy printout and keep it ready before start watching the problems. Now first problem I am reading out. From the following information, compute Mr. Rao's income from interest on securities. Income from interest on securities. Rupees 67,000, 12% tax-free debentures of Messrs. Raman and Company. Second, rupees 88,500, 15% Mumbai Municipal Corporation bonds. Third, rupees 25,000, 10% 12-year National Defence Certificate. And last one, D point, collection charges are 15,000. Now see here, previous video I have explained you how to compute the interest on securities. Security means the bonds issued by the government or debentures issued by the companies. These are called securities. The interest received on bonds or debentures are taxable under income from interest on securities. It's a part of income from other sources, right? Now, how to calculate the interest on securities? Income Tax Act has divided the securities into 3 categories. Exempted from tax security, tax-free security, and less tax security. First of all, exempted from tax securities are those securities on which the interest is completely exempted. Income Tax Act has given the list of the securities. a list of the securities I have explained you in the previous video. So first of all, you have to see if the security is exempted. Just you have to write a note to the interest on these securities are completely exempted. It is not taxed. Second category, tax-free security. Tax-free securities are those securities on which the tax will be paid by the issuing authority. The issuing authority may be government or may be the company. If the bonds are issued by the government, then government will pay the tax. Will pay the tax on that interest on securities. Similarly, if the companies have issued interest tax-free securities, then the company will pay the tax on the interest on security. That is tax-free security. If it is a tax-free government security, gross interest is equal to face value into rate by 100. Gross interest is equal to face value into rate by 100. If it is a tax-free commercial security, then two steps. The first step, we calculate net interest. Net interest is equal to face value into rate by 100. Then gross interest is equal to net interest into 100 by 90. So if it's a tax-free commercial security, two steps. First step, we calculate NI, net interest. Second step, we calculate GI, gross interest. When? If it is a tax-free commercial security. If it's a tax-free government security, only one step. Gross interest is equal to face value into rate by 100. That's it. Third category is less tax security. Less tax securities are those securities on which the issuing authority will deduct the tax from the interest on security. From the interest, it will deduct the tax and net interest will be paid to the security holder. Net interest will be paid. The issuing authority will deduct the tax from that interest and net amount will be paid. That is less tax. Less tax may be government or commercial. Again, for all less tax security, only one step. GI, gross interest is equal to face value into rate by 100. That's it. These are the provisions we have to apply in the current problem. Now, computation of income from interest on security of Mr. Rao for the assessment year 2021. First one, rupees 97,000, 12% tax-free debentures of Messrs. Raman and Company. First of all, the tax-free debentures are issued by Raman and Company, so it's a commercial security. It's not a government security. It's a commercial security. When tax-free commercial security is there, two steps will be applied. The first step, net interest. So net interest is equal to face value into rate by 100. What is the face value? 97,000. What is the interest rate? 12%. So 97,000 into 12 by 100. 97,000 into 12 by 100. So you will get 11,640. You will get 11,640. This is the net interest. To net interest, next we have to find out the gross interest. The gross interest is equal to net interest into 100 by 90. 11,640 into 100 by 90. 100 by 90. We'll get 12,933. This is the procedure given by the Income Tax Act 1961 regarding the calculation of interest on security. Why 100 by 90? Because 10% is the TDS rate. TDS rate is 10%. So 12,933. This is the gross interest for first one. Second one, rupees 88,500, 15% municipal Mumbai Municipal Corporation bond. Mumbai Municipal Corporation bond. If nothing is given, we assume it is a less tax security. When the word tax free is not given, we have to assume it as less tax. So here Mumbai Municipal Corporation bond is a less tax security. So only one step, we will get the gross interest. Gross interest is equal to face value into rate by 100. 88,500 into 15 by 100. 15%. 15 by 100. 13,275 is the gross interest. Now third one, rupees 25,000, 10%, 12-year National Defence Certificate. In the previous introduction part, I have explained you 12-year national defense certificate is a fully exempted from tax security. Fully exempted from tax security. That means interest on this security is not at all taxable. It is exempted. That point you have to remember. Time to time we come across which are the securities on which there is no tax, exempted from tax security. In the previous video I have given some 12 to 15 examples of the securities which are exempted. Now here it is not taxable, fully exempted from tax, put a dash. Now take the total 26,208 is the gross interest. From gross interest, a deduction under section 57 will be allowed. Only two deductions are allowed. First one, collection charges, and second one, interest paid on loan taken to purchase the security. Interest paid on loan taken to purchase the security. But in our present problem, it is not there. Only collection charges are given. So deduct collection charges, will get income from interest on security. That's all. The first problem I have explained you in detail regarding. These provisions you have to remember. If it is a tax-free commercial, two steps, net interest, then gross interest. If it's a tax-free government, only one step. If it is a less tax, only one step. That's it. And national defense certificate is fully exempted from tax. Now I am coming to the second one. Compute income from other sources of Sri Vikas for the assessment year 2021. Previous problem we have calculated income from interest on security, but here we have to compute income from other sources. What are the items given? Dividends from UTI. Previous video I have explained you. Dividend from UTI are completely exempted from tax. Any dividend or any income received from UTI, mutual fund, is completely exempted. This point you have to remember. Normally students will find this subject income tax difficult. The reason is they cannot be able to remember the provisions. A little bit extra effort is required to remember all the provisions. Which income is taxable, which is not taxable, what is the rules, all these things you have to remember. So income from UTI, completely exempted. Then 15% interest from post office saving bank, rupees 10,000. Again, previous video I have explained you. Interest received from post office saving bank is completely exempted from tax. Both are here. That means dividend from UTI, not taxable. Interest on post office saving bank, not taxable. Third one, interest on fixed deposit from Punjab National Bank, it is taxable. It is taxable under income from other sources. Then 30,000 7% debentures of JCT Limited and 1 lakh rupees 8% tax-free commercial security. So we will have income from interest on securities. These debentures purchased and other tax-free securities purchased, these will come under income from interest on security. The bank charges 2% commission on collection of gross interest. So collection charges deduction will be allowed. 2% on gross interest. That is the problem. First of all, computation of income from other sources of Sri Vikas for the year assessment year 2021. Interest on security. First of all, I am going to calculate the income from interest on securities. First one, rupees 30,000, 7% debentures of JCT Mills Limited. Nothing is given. Tax free is not given. When tax free is not given, it means it's a less tax. It is a less tax. For less tax, only one step, gross interest GI is equal to face value into rate by 100. So what is the face value? 30,000. What is the rate? 7%, 7 by 100. 2,100 is the interest, gross interest. Second one, rupees 1 lakh, 8% tax-free commercial security. Specifically given tax-free, and it is given commercial. 2 steps. First you calculate NI, then GI. NI, face value into rate by 100. Net interest is equal to face value into rate by 100. 1 lakh into 8 by 100, 8,000. That is the net interest. Now gross interest is equal to net interest into 100 by 90. 100 by 90. So 8,000 into 100 by 90, 8,889. That is the gross interest. Now take the total of these two. Gross interest 10,989. From 10,989, collection charges, deduction under section 57 will be allowed. Collection charges, it is given in the problem 2% on gross interest. So 2% of 10,989, 220. 220, deduct 220, you will get 10,769. This is income from interest on security. Now, dividend from UTI, just now I told you, remember this provision, fully exempted from tax. 15% interest from post office saving bank, rupees 10,000, fully exempted from tax, put a dash. Then interest on fixed deposit from Punjab National Bank, it is fully taxable under income from other sources, 7,000, fully taxable. Now total income from other sources are 17,769. Two problems completed. Now see the third problem. Compute income from other sources from the information given below. Gift from friend. Gift received over 50,000 is fully taxable, whether the gift is received in kind or cash or kind. Any gift received over 50,000 rupees, whether in cash or kind, is fully taxable. Fully taxable. Below 50,000 gift is received, it is not taxable. That means you should not say that 50,000 is the exempted limit. No. If he is having more than 50,000, complete amount is taxable. So here 75,000 is the gift. Full 75,000 is taxable under income from other sources. Interest on bank deposit, it is also fully taxable under income from other sources. Winning from lottery, it's a casual income. It is taxable under income from other sources. But gross amount we need. Here net amount is given. Net 70,000 rupees is given. We have to make it grossed. How to gross up? Multiply 100 by 70. In the previous video I have explained, 30% is the rate of tax on casual income. 30% is the flat rate of tax on casual income. So we have to gross it up. So net amount 70,000. 70,000 into 100 by 70. 1 lakh. The gross amount of winning from lottery is 1 lakh. 1 lakh rupees is included. Then dividends from Reliance Industries 38,000 gross. Reliance Industries is an Indian company. And again we have discussed in the previous video, dividend received from Indian companies are fully exempted from tax up to rupees 10 lakh. If the total aggregate of all dividend received from Indian companies are more than 10 lakh, then the excess will be taxable at a flat rate of 10%. Over 10 lakh, the total aggregate dividend. But here the dividend received is only 38,000. Only 38,000. So dividend received from Indian companies are fully exempted from tax. That's it. Now, see, computation of income from other sources of Mr. Dash for the assessment year. Gift from friend, 75,000, fully taxable. Interest on bank deposit, 18,500, fully taxable. Winning from lottery, 70,000 net amount. But we should not take net amount, we know gross amount. So gross interest is equal to 70,000 into 100 by 70, 1 lakh rupees. Then dividend from Reliance Industries, gross 38,000, fully exempted from tax, put a dash. Then income from other sources, 1,93,500. See, in these problems I have not given the working note. Unnecessary time will be wasted. But while watching, while listening this lecture, you should simultaneously write down what I am explaining. If you want the complete command, just to follow my instructions. That whenever you are watching, keep a notepad beside you. Keep a pen. As soon as I tell something about the provisions, immediately you should note it down. That will make a lot of difference in your knowledge. Otherwise, simply if you are listening means there is a lot of chance that you will forget it. So on a piece of paper, on a notebook, keep on writing whatever I am explaining. And those notes you have to write here. Example, I have given explained about gift from friend. So a lot of provisions are there, gift from friend. Up to 50,000 not taxable, over 50,000 cash or kind gift received is fully taxable. Fully taxable, no exemption. You should write on that. Interest on bank deposit is a part of income from other sources, fully taxable. Whereas winning from lottery, net amount is given, but we have to take it gross amount by multiplying 100 by 70. Dividend received from Indian companies, whether equity dividend or preference dividend, that is not taxable up to rupees 10 lakh. All these are the provisions you have to write in working note in examination. So we have completed 3 problems on this income from other sources.